over the past 40 years, the U.S. economy has been bouncing around like a really wicked roller coaster, right? Good times, bad times, everything in between. But storage, it's like that lazy river, Sam, when you got your little cocktail you're floating around at your resort on your little inner tube there. I mean, it's just gently meandered between about 80 and 90% for that same time period, 40 years. So we really like that steady predictability and the increasing demand, and it's a high cash flowing business. So we're really enjoying it.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Tom Dunkel is a former aerospace M&A guy. He's got 17 years as a full-time real estate investor. If you don't know, Tom actually came back on the show September 18th of 2022, which if I'm not mistaken, that was episode number 658. So if you want to go back and hear a little bit more of Tom's story, you can go back there again, check that out on September 18th of 2022, episode 658. Otherwise, Tom, welcome to the show. There are 3 questions that I always ask every guest who comes on. I know you got this question last time, but maybe you'll answer it differently this time. And if our listeners haven't heard that other episode, they want to hear it again anyway. So where did you start? Where are you now? And how did you get there in 90 seconds or less?
Got it. Thanks, Sam. It's great to be with you and the listeners once again. Great show. So as you mentioned, I started out in corporate America after business school. I was kind of the number crunching, Excel spreadsheet nerd. I was putting together the projections and the pro formas for our aerospace acquisitions, doing the valuations, doing the market work to see like who are the competitors out there, what were they doing, how could we position ourselves, and all those kinds of things. So I got to work with some amazing people, Harvard MBAs, Wharton MBAs, Naval Academy graduates, Chicago MBAs, retired Air Force colonels, and even some astronauts. And if you catch up with me after the show, if you visit with me on my website, I'll be happy to share with you the 2 astronauts that I've actually had lunch with. So from there, Sam, went into a couple other jobs corporate wise. And I just knew all along that, scraping and clawing up that corporate ladder just wasn't for me. I knew there would be a better way. So 2006, I got my opportunity when I was fired from my corporate job, finally gave me the kick in the pants that I needed to go out and do my own thing. So of course, 2006 was a rough time to get started in real estate, but, I went in full bore and got my butt whooped pretty good those next few years. But learned a lot, got some battle scars, and but persisted. And now here, 17 years later, I've built multiple 7- and 8-figure business. And now we're in the self-storage space, which is a ton of fun. And I'm sure we'll get more into the details there later. But in 90 seconds, that's the story.
That's the summary. I love it. Have you always done just self-storage, or do you have other real estate holdings as well?
Yeah, so right now, self-storage is our primary business, but we do, through the years, of course, being entrepreneurs, we try out different things. So we also do have a short-term rental portfolio. There's a mountain and lake region here north of Philadelphia called the Poconos. Mm-hmm. And so we picked up some Airbnb rentals up there, which were really hot during COVID. And then we also have a distressed mortgage debt business. And that was the business that I started after getting my butt whooped in the residential world. In 2009, I started buying notes, and then 2010 and et cetera. And that business has done real well for us over the years.
Considering the various businesses that you're involved in, what were some of the hallmarks rather of why you pivoted from one to the next? And was there any expense in not staying with just one?
Yeah, that's a great question, Sam. So distressed mortgage debt has been great. I mean, we've generated over $53 million of revenue in that business, and we're not a big company. So that's done real well for us. Wow. Problem is, it's extremely unpredictable. And it's not like we can go up to Big Bank USA, knock on the door and say, hey, sell us some loans. So we were strictly at their behest, their whim as to, what loans they were going to sell, how many and when. And so for like an MBA guy like me, taught how to put business plans together and KPIs and whatnot. I mean, it just became impossible to really predict the future in any way, shape, or form for distressed debt. So even though that business is still rolling today, it's strictly, you know, when a deal comes up, we kind of shift and we jump at it. We have a team that's able to do that. And then we got to shift back. But so along the way, we had been looking for an asset class where there was some predictability. You know, there was some stableness. There was, you know, a way to put a plan together and put a team together and really, you know, build a business. So we actually started out looking at private lending, hard money lending. And we really like that business, and we still do a little bit of it sort of on the side, but we were just not able to get the traction to get that business up and running. And one of the big reasons is it's super duper competitive. So that's a big takeaway I would give to folks out there is, you know, be careful about what asset class you choose, because if it's super competitive, you know, you're going to have a hard time making hay. So when that business didn't work out the first time, we thought, hey, let's try this again. We did it so good the first time. So we failed at that business twice. And we got involved with a title company. And because again, we thought that was going to be, you know, a lot of small transactions and predictable, but again, couldn't find really the right relationships and team to put to bear there. And then, you know, about 2017, 2018, we started hearing more and more about self-storage. We were like, okay, this is checking a lot of boxes. Very fragmented industry. So you know, there's a lot of moms and pops. The big names that you've heard of out there, they only control about 30% of the market, the Public Storage, Extra Space, CubeSmart, et cetera, those big guys. So the vast majority of the market is just small onesie, twosie mom and pop owners, which was very attractive. The second thing we found super attractive was just the adoptability, the market penetration of self-storage. A few years back, only about 8% of households in the US were using storage. Fast forward to today, it's going on 11% and increasing. And I know maybe 3% doesn't sound like a lot, Sam, but when you consider there's 120 million households in the country, every 1% move is 1.2 million new self-storage customers. And they're just not building them fast enough. So we've got increasing demand, you know, supply increasing not as much, which means that there's going to be upward pressure on rates, which is awesome. And then I guess the last thing I would throw out there is just that over time, over the past 40 years, you know, the U.S. economy has been bouncing around like a really wicked roller coaster, right? Good times, bad times, everything in between. But storage, it's like that lazy river, Sam, when you got your little cocktail, you're floating around at your resort on your little inner tube there. I mean, it's just gently meandered between about 80 and 90% for that same time period, 40 years. So we really like that steady predictability and the increasing demand, and it's a high cash flowing business. So we're really enjoying it.
No, I think that's all of those are excellent reasons to get involved. I'm shocked that 30%, only 30% of the self-storage market is controlled by big names. That's a shocking statistic to me.
A big one.
I would not have guessed that today, that's still the case, which obviously I guess it is. I would think that though having those big industry names behind it, like those consolidating entities, is probably a good thing, just in the sense that it brings market awareness. It brings, I mean, it has to improve resale value of your guys' facility if you decide to resell at all, if that's even part of your strategy. Is that not a fair analysis?
Yeah, so the REITs it's kind of a double-edged sword with them. So if they are in a market where we are, they have a lot of sway, right? They've got big marketing budgets. You know, it's usually a big shiny building right on the corner in the middle of town, you know, that kind of thing. So when they come into town, especially if they're building a new facility, what they will do is they'll really drive down the rates in the entire market just to get their facility filled up, and then they'll kind of boil the frog slowly and up the rates. And so, you know, in that situation, we have to follow them, unfortunately. So that's part of our analysis, Sam. When we are looking at acquiring a facility, we're looking to see who are the competitors. Is it Joe's Self Storage, or is it, you know, public storage. And so we need to be cognizant of the fact that there is a REIT or are REITs in the market. And so that's just going to just make us think a little bit more about how we're going to address that. But yeah, the thing though is, if they are already established in the market, they're going to be pushing rates. So that's the other edge of the sword is, we can then ride that wave as well, by either, doing maybe a small discount off of what they're doing, or if all the facilities in the market are full, which does happen, then we know we can really kind of push that demand curve and push those rates and just kind of see where that equilibrium is, and really be more aggressive about bumping up our rates.
Yeah, that's interesting. I would have, I mean, it makes sense, obviously, what you said, but I would have guessed the other way around would be that your mom and pop owners would be the ones that are keeping prices artificially low because, well, we just had our prices here and we don't want to upset our customers, so we're going to keep it here. It's like,
no, you're spot on. That's 100% correct. Sorry if I got off on the rails there, but no, you're 100% correct. And that's one of the things we look for when we're acquiring a facility is a mom and pop, their big KPI. We were talking about KPIs, key performance indicators, before we hit record. And that's their like only KPI, seems like, is, are all my units full?
right.
That's what the mom and pop operator does. The last thing they want to do is have to have a fancy website or implement technology or a marketing program, or, God forbid, throw out some Google ads or, something like that. It's just not how they run their business.
Right.
They're just looking for that mailbox money, and they know their rates are low. They know that their delinquencies are high, but they just don't want to upset the apple cart because they know all their customers a lot of the time.
Right. No, that makes a lot of sense. But I mean, that's where the meat on the bone lies, right? It's like, oh, okay.
100%.
Like, I'm thinking about which we're long in the laundry business, and I was thinking about a store we just bought, and we literally raised rates 53%.
Oh, yeah. Right.
Because who knows how long it's been since they've raised rates. I mean, of course, again,
that's right.
It's all the little sophisticated, I'm not even call it sophisticated, little things that you can do that drive a business in a meaningful way that you just mentioned. Like,
yeah.
Oh, hello, Google ads. Okay. Pay-per-click campaigns. Okay. We're marketing. Okay. We have a phone line.
Right.
I mean, how many of these facilities you're buying where you're like, you guys don't have a website and a phone number that there's a live person?
And we're actively surveying the market to see like who's charging what and how busy are they.
Right.
Yeah.
Right. And those are where your competitive edges lie. What's your thought? Maybe you answered this, but I'm going to ask it again anyway, just to see if there's more to this than not. What's your thought on being a price leader or a price follower?
Yeah, good question. And I hate to say this, but it's going to depend on the market. So, for example, we acquired a facility in Mount Airy, North Carolina, a couple years ago, and the entire market, in our analysis, we discovered that the entire market was full.
Oh, wow.
And so we knew when we acquired our facility there, Granite City Storage, we knew that if there's a customer in that market that wants a storage unit, they're going to have to pay more, because if we bump up the rates even on our existing customers, where are they going to go? So we were able to successfully play that game in that market, and we increased our rates about 21%.
Wow.
In the first few months, and then we were just able to bump it up kind of incrementally from there. But yeah, I mean, that's a big factor, is what's going on at the other stores. But like we talked about a minute ago, if there's a big new development going in and there's a REIT coming in, we're going to be more of a price follower in that situation. And what I meant to add on to my first example, North Carolina, all the other competitors in that market, they followed us. After they saw that we were bumping up our rates. They all, bump up their rates, right? And then I don't remember getting like a holiday card or like a commission check that year from those guys, but we should have for sure. But yeah, on the other side, with the big REITs coming in or big developments coming in, you're going to end up most times being a price follower in that situation.
Right. Yeah. It's a temporary race to the bottom. I would
That's
think,
right.
but as you
Honestly, which is why, Sam, sorry to interrupt, but
please.
which is why, like, people look at these really hot markets, like down in Florida and stuff, millions and millions of people moving there, or at least hundreds and hundreds of thousands. But we don't like to see that the market being too hot, because we know it's going to attract the REITs, so we're looking for that Goldilocks situation where it's growing, but enough to increase demand, but not enough to increase or attract a lot of competition.
What's one of the things that you have done from a management perspective? And you're based in Wayne, Pennsylvania.
That's
So,
right.
and you're buying things in Mount Airy, North Carolina.
That's right.
That's more than a 5-minute drive from your house.
That's right.
So how have you
Yeah.
established systems and and established the right people to manage these at scale from a distance?
Yeah, I mean, that's really the magic, the secret sauce, although it's not very secret. I mean, you hit the nail on the head. It's getting the right team together, right, with the right systems. And of course, we're leveraging technology to the max. So those moms and pops that we buy from, a lot of times they don't even have a website. And if they do, it's stale information, it's rates from, a few years ago, and the phone number's wrong, all those kinds of things. So we implement what we call a hybrid management strategy. So each of our facilities has a human that is assigned to it, but because we leverage technology, the phone number that is at the facility, if they call our facility in Douglasville, Georgia, it's going to ring on the cell phone of the human manager, but they might be out in Missouri. And so, but because of technology, they're able to answer the phone. Hi, it's Douglasville self-storage. And then, 9 times out of 10, they can handle whatever the customer inquiry is just right there on their smartphone. Right. And in the event that the manager's busy, or maybe they are not able to pick up the phone, if the customer is at the facility, they're gonna see one of these. They're gonna see a QR code. And if anyone out there wants to have a little fun, you can scan this on your phone and you can rent a unit from us at our Baltimore facility. But the customer can just go up, scan that QR code. It'll take them to the website. They can fill out all their personal information, load in their credit card for auto pay, which is awesome. And then just sign the contract with their finger. And then once they submit all that, they get a gate code texted to them while they're right there standing outside the gate. Punch in the gate code, gate opens up, they go inside, they find their unit, empty out their stuff, lock it up, and they're on their way without having to interact with a human at all. So we love doing that, and it allows us, Sam, to really drive down our operating expenses at our facilities, which is everyone out there, I'm sure, knows, because you've got a smart audience. That drives up net operating income, which drives up the value of the facility, which is the whole purpose of our value add strategies that we implement.
And it improves the customer experience. I mean, that's the last thing is, yes, it drives up NOI. But Tom, if you gave me the option to rent from you where I can do it from my phone, plug in my information and be done in 5 minutes versus walking inside, being handed, 42 pieces of paper and filling out all my information.
That's right.
Man,
that's right. And you got that generational difference too, right? I mean, millennials are our biggest generation right now in the US. And that's, they were all born with a smartphone in their hands pretty much, right?
Right. For better and probably for worse.
That's right.
Yes, that's very, very true. Tom, we've got just a few minutes here left, and I wanted to highlight a couple things and just get your thoughts on them. This is, again, the fact we talked about this in the beginning. You came on September 18th, or the show published September 18th of last year. Some things have changed. Some things have changed in the financing side of things and the sales side of things. Tell me, how are you guys navigating the current lending environment? How has that affected deal flow? How has it affected pricing? I've asked 3 questions. I'm only supposed to ask one at a time, so it's up to you now.
Sure. Yeah, I mean, things have certainly been dynamic the past 9 months since we spoke last, and interest rates are up, 4 or 5%. I mean, which is huge, right? I mean, we were doing deals at 3.75 or 4% debt back then, but now it's a different ball game, and we've been able to adapt. Of course, none of this was really a surprise. I mean, we all saw all the money that had been printed, and that inflation was coming, and that was going to push up rates. And so we, having been around the deals and projections and all that for many, many years, geez, wow, going on 30. Wow. Anyway, I'm not that old. So we knew this was coming, right, Sam? So we were already adjusting our models, adjusting our exit cap rate assumptions, and our future rate assumptions, and all those kinds of things. And so we've been very disciplined and about the facilities that we purchase. And for that reason, we haven't purchased a whole heck of a lot. I mean, we just closed on our 13th facility. We've got our 14th coming up here soon. But our acquisition pace definitely slowed down because a lot of sellers were looking back a year saying, oh, I want that value, from back then. And we're saying, well, sorry, that's off the table now. Because our cost of capital is up, and we have return targets that we need to hit for our investors. So that's definitely slowed us down. But I guess the good news about that is because of the run up in pricing the last few years, there's a lot of owners out there sitting on a lot of equity, and that has allowed us to take advantage of seller financing. So we did a seller financing deal in the fall. And we have 2 seller financing deals lined up here that'll be closing here in the next month or two. And the beautiful thing about that is, it's really a win-win, right? Because the seller, they're not getting a big tax hit right up front, because if they took the whole net purchase price in cash, they'd have to pay a big chunk of taxes on that. So seller financing allows them to kind of push out their tax liability there. And then for us, there's no big onerous underwriting process that you have to go through with an institutional lender. There's typically no personal guarantees, which again, on smaller deals from a credit union or a small local bank, they're going to be looking for personal guarantees. And the terms are typically pretty great. So we're seeing interest only payments, which of course means lower payments, higher cash flow left over for our investors. So we love to see that.
Absolutely. Tom, this has been enlightening. Thank you for taking the time to come on the show today and share your thoughts, your kind of updated thoughts here with us on the market, how you guys are handling it, what you guys are doing there in the self-storage space. It's a pleasure, of course, to have you come on a second time. You're an absolute wealth of knowledge. I do appreciate it. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
Sure, Sam. This has been great. Love the questions. Great energy. Love it. So yeah, I'm Tom Dunkel. I'm the Chief Investment Officer here at Belrose Storage Group. You can find us at belrosestoragegroup.com. We also have a Facebook page. If you want to search Belrose Storage Group on there, you can find my past podcast interviews and other articles and value add that we put out there for our investor community. So yeah, I'd love to hear from you, and I'd love to schedule a call. You can do that from our website as well. But yeah, we're active. We're out there doing self-storage deals, and we're doing syndications with accredited investors. So love to have you come join us.
Fantastic. BelroseStorageGroup.com. We'll make sure we include that there in the show notes. Tom, thank you again for your time today. I do appreciate it.
Thank you, Sam.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much, and hope to catch you on the next episode.